Okay, so volumes, as we mentioned before the break, volumes in the US markets are still pretty low, and there seems to be just that worry that confidence hasn't fully returned in that regard. Carson Scott spoke with George Lucas from Instreet about the implications for the Australian markets.
We're in this period where they're waiting for the job numbers, as expressed before, and so everyone's sitting on the sideline. And we're actually seeing the same thing happen a little bit here in the Australian market as well. And so yesterday when we saw the All Ords fell, the Australian market fall, most of it was led in the small cap companies. So the small ords, as we call them, which are the 200 companies in the ASX 300 but don't make up the 100, fell 3% yesterday, just mainly because there were no buyers and people trying to sell out of the stock.
Okay, so they reacted yesterday, you're saying, what, to the job ads survey, which is a lagging indicator. And it's only 1 month's worth of data as well to boot. I mean, why make a judgment call in such a strong way to sell down based on those numbers?
Yeah, and I also think unemployment is a lagging indicator in most circumstances, except when we're in a credit-led recession like we're in now, and especially in the US where, you know, we need to see the unemployment rates start to fall so that people can, we get loan improvement or quality of loan improvement on the from consumers, which will improve the bank balance sheet. So actually, in a credit-led recession, I think unemployment becomes more of a coincidental indicator because it links straight to the health of the banking system in your country.
Well, bearing in mind that there is effectively, therefore, still 90-odd +% of that economy still in employment, if you take out that 10%. Now, surely credit growth does not hinge on just that 10%, because if anything, in fairness, that's probably the subprime component of lending that you wouldn't even be going towards anyway.
Yeah, some people actually say 10% in the US is quite optimistic for an unemployment number, and the unemployment rate, with a hidden unemployment rate, is more like 27% currently in the US.
So, I mean, yeah, that's such a movable feast. Others would say to me 16%. How do you extrapolate as high as 27?
I'm really just looking at things of, you know, the number of people in part-time employment and people who are not reporting to work anymore and areas like that. But
why is it so imperative, George, philosophically, that that sector of the economy is lent to by banks?
Well, it's a small it's a small business, are the ones who employ people. And there's this, Obama's picked this up and he's putting a lot of tax credits in for small businesses to start hiring people and to encourage loans from banks to small businesses to hire people. And that's in US, that's where the job growth comes from, the small business sector. And so it's very imperative to improve the credit quality of the consumer and their balance sheet so that banks will start lending to small businesses again and small businesses will start hiring people.
Mm-hmm. And what's the timeline on all of this?
Well, they're trying to get it, you know, they've basically neglected the job growth situation for the last year as they've tried to push through their healthcare and other reforms through. And so the timeline for them has moved up quite significantly, and it could take a year to start improving the credit quality of the US consumer.
Mm-hmm. Now, bring it all back here at home. We do have an interest rate decision today. For your money, what would be the smart thing to do?
I think the smart thing to do is actually to bet that there will be an interest rate rise. The money market actually only has a 70% probability of an interest rate rise, which is quite interesting because last week it was at a 95% probability and it has come back a little bit. But I think the smart money is on an interest rate rise. The thing that you have to watch out, and the thing which I noticed yesterday, was that the aggregators, the mortgage aggregators, are beginning to report that the number of mortgages that they're putting out there is falling at quite a dramatic rate. And obviously credit creation is something that the Reserve Bank is going to be looking at very closely, not just the inflation. And so if we get to a situation like we had at the end of 2008 where there's no credit creation, the Reserve Bank will stop hiking rates. And so if we see no more consumer credit creation and the drop-off in mortgages, I think the pressure comes off the Reserve Bank to hike rates.
What about, though, the attendant pressure of a buoyant labour market relative to the rest of the world and wage pressures that will be starting to arguably then come through on that front? Does that unsettle that other consideration you just flagged?
No, I think one of the main things they'll be looking at is credit creation. Australia's obviously, what you're talking about is more of a long-term theme for Australia, and Australia's obviously blessed by two driving forces in the long term at the moment. We have a very high population growth. We're back to the 60s in population growth, so we're above 2% population growth per year. And on the other side of that, we have the other is the Asian, the link into Asia and the boom for our economy from commodities themselves. So for a long-term theme, that exists, but I don't think for in the short term, and this is a short-term trading market, you have to really worry too much about the constraints put on by the labour market into inflation.
Brief final thought. We were saying before we came on air, 5,000 for you is a tangible target to touch, what, by the end of the year now? Have you pushed back your projections on when we might hit that level?
Well, I was a little bit surprised that the market fell in January, where I was expecting it more to fall late February, March. We could see another 2 to 3%, even 5% from this level off the market. But I think the China situation will calm down and people will begin that, cutting back loan growth is not the end of the world in China, and China will continue to grow.
Our earnings season, what will be the main thematic from that? What will be the main takeout from the companies that are going to come through?
I think you'll see in the earnings seasons that the analysts this year have been very conservative on their earnings, and so we'll see a lot of upgrades like we had with Aristocrat yesterday, where it significantly beat earnings. I think that will be a continued theme throughout this earnings season, that we'll find that the analysts have underestimated the earnings just because they've been being very conservative after what's happened in the last 2 years. And so I think from that point of view, that will add fundamental support to the market. And so after this earnings season's completed, I think that fundamental support can drive the market above 5,000 by the end of the year.
Let's get some further details on US President Barack Obama sending Congress a $3.8 trillion budget blueprint for the next fiscal year. It projects a record deficit of over $1.5 trillion in 2010, and John Decker has details.